We know that tech has the most exposure to foreign sales and semi in particular, but the true sort of cyclical trade, this melodious phrase, synchronized global growth, I want to talk about industrials and financials because this has been the dream since the election in 2016 that you want to be long financials and industrials for tax cuts and for all the good things that have been announced, and yet it's really not working. So what I have here is every single S&P 500 industrial and financial stock, about 140 names, $6 trillion, plotted equal weight. That's the key. And they represent about 25% of the S&P. The top chart is a beautiful uptrend. Again, you have names like Caterpillar and Boeing, American Express, Goldman Sachs. One, we've broken trend. But here's the more important thing, at least by my work. We have undone the entire move from the election so that this is relative performance to the S&P 500. All of the alpha was an 8-week period, and the whole thing has been given back. And we're well below where we were on a relative basis from the election, basically getting to be almost 2 years ago. Let's move on to a few other things. We have the circumstance as of Friday where both industrials and financials as sectors closed at the midway point down. Now, that has only happened 9 other years. You see it right here. And what I looked at was what happens to the S&P performance in the second half in those years. The average performance down 61 basis points, median down, compared to the average second half of up 4 or 5%. This is not a good setup either. So finally, I want to look at the correlation. They are running at about an 89% correlation over the past 1 year. Now look at over the past 5 years. They are literally the same percentage gain. And each of them, if I were to have a trend line drawn, have broken trend. And they also have all the elements of something what is known as a head and shoulders top. This is not good, and it speaks to, if this isn't working, can we continue to be saved by tech? And what if tech doesn't hold up?
Carter's going to come back.
Sure. It's almost beyond precedent for a guy to leave the desk and not ever come back and have an empty chair. I don't want that happening on my wall. Well, in your case, that's not a surprise.
Hit my chair.
It's not a surprise, Dan.
Well, next time, Carter. So at the beginning of the year, when everybody came out and they were saying be overweight financials, were you thinking in your head financials and industrials have a really high correlation? So if you say overweight financials, you by default have to be
right. I mean, it's the trade that is, if taxes are cut, if interest rates go higher, the two things that people have relied on really have not happened, or if they have, they haven't had the intended effect on those securities. But the problem is that that's 25% of the market, and that's really where cyclicality is. Energy can't move the market. We know that healthcare is sort of stuck. We know that staples have got their issue. So that if the core middle, so to speak, the cyclical names are not working, and yet we're clustering in more and more into the tech names, and tech were to falter, there's really, by definition, not much that could help if we get into trouble.
So I agree with that, except for if I look at the market going back 5 years, tech has been the horse, right? If I look at Qs against the S&P, they've outperformed substantially. They've outperformed even since the market peaked by 7 or 8%, whereas you said the industrials have underperformed. So while I get concerned at the price action in the stocks, shouldn't this just be a continuation of what we've had and a different composition, frankly, of the economy?
Well, all true. The issue is, in those past 5 years, has tech had meaningful drawdowns? It has. All we have to do is have another such meaningful drawdown, and by inference, the market draws down.
I think what's also interesting at this time now, we know that obviously buy boxes helped out a lot on EPS growth. We now have this tax cut from last year that's helping that too. But all of a sudden now we've seen this spat of IPOs. It's the busiest year in IPOs at 120 this year, busiest year since 2012. And it's likely to be the busiest since the dot-com bust, back in 2000. So all of a sudden you have this new supply, and that's great. I'm happy for some news names to talk about other than FANG on this desk. I mean, wouldn't that be fantastic? But don't forget about that supply. I mean, that's a really important thing. I know it doesn't mean much, $35 billion so far in IPOs, but a lot of these things have performed very well, and it gets people attention going to other things. And the last thing, all this media merger frenzy, it kind of feels a little bubblish too. So
it doesn't. It's a sector that's in transition, Dan. I mean, that to me is totally based upon a bottom-up call on what's going on. I mean, their business is at stake right now. It doesn't surprise me that they're all buying.
Right, but they're tripping over each other, Tim. Bidding stuff up to levels that don't make any sense. When a lot of people actually couldn't justify
maybe not smart for Disney
the strategic sense that they made from a valuation standpoint, the debt that they have to take to do these things, trust me, we're going to look back and say, was it a brilliant idea?
I think that's right. But to say that that's an overall tell on where the market is,
I'm not saying.
I think this is a secular dynamic
I think
rather than a cyclical dynamic.
Part of a pastiche is what he said.
It would be a mosaic of sorts.
Mosaic, exactly.
If he used pastiche, I was allowed to.
If he used pastiche, Tim wouldn't have interrupted him.
Probably not.
I never interrupt anybody.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.